Okay, so good day, and I hope you are all doing well. So we are going to start a new course on Introduction to Forex Trading. That is a beginner course and explaining what Forex Trading is all about. Okay, so this is a new series I'm starting on Introduction to Forex Trading. All you need to know about Forex Trading. So first of all, if you've not subscribed yet, subscribe to this channel and also like all our videos we've posted before, and also try like this video too. Okay, so let's head straight into it. Now, introduction to forex trading. In this particular course, these are the content, or these are what we are going to talk about. That's what forex trading is all about. A brief history of forex trading, types of market, importance of the forex market, the market participants, the forex market structure, what currency pairs are or what currencies are, how forex trading works, tools and platforms for forex trading or trading, and types of analysis. So let's start. Forex trading is also called foreign exchange trading or FX trading. It's the process of buying one currency while simultaneously selling another with the aim of making a profit from changes in exchange rate. Forex is the most liquid market globally, having over 7.5 trillion traded every day, and the forex market operates 24 hours 5 24 hours and 5 days a week across major financial hubs like the London, the New York, and the Tokyo. Every forex trade involves a currency pair. If you believe the euro will strengthen against the dollar, you buy the euro USD. If you believe the euro will weaken, you sell the euro USD. Now we go into a brief history of how forex trading actually came into existence. In the ancient times where forex trading started, people first traded by barter. That's you were trading goods for goods. Let's say you have a particular thing and you want to exchange with, or you want, let's say you want. Okay, let me make a description of it in which will make it become very modern. So let's say in our modern world right now, where we want to do the Asian type of trading, that was the barter trading. Let's say if you have a car and you need something like a belt, okay, you trade a belt for the car, right? Yeah, you trade the car for the belt, right? Yeah. So that was how the whole thing was. That kind of trading, like you bring a good and actually come for another good. That was how those times trading was. Later, coins and precious metals, that's gold and silver, were used for international trade. Merchant and money changers in places like Greece, Rome, and the Middle East exchanged currency for cross-border trade. Later on, during the 16th to the 19th century, that was the earlier market. The first structured currency exchanges in Europe, that's in Amsterdam, that's in 1500s. The Medici family in Italy created banking system that enabled currency exchange across countries. In the 19th century, gold standard was introduced where currencies were tied to gold, giving them stability for exchange rates. Then later on, we had the 20th century. That's after the World War One and the World War Two, countries abandoned gold standard to print more money, leading to unstable exchange rates. So when countries started actually printing more money, then exchange rates were not stable, right? Because we didn't have a standard in which we were exchanging things. You get it? So in 1944, Bretton Woods Agreement, okay, Currencies were pegged to the US dollar, and the US dollar was tied to gold. This made the dollar the world reserve currency. Okay, in 1971, end of Bretton Woods, the US stopped linking the dollar to gold and currency began to float freely, which marked the state of modern forex trading. In the modern forex trading, in the modern forex trading, like we discussed in the 20th century, in 1970s, electronic trading started in banks and financial systems. In 1980s, 1990s, internet technology made forex available for investors. Okay. So we have types of trading or types of markets. For the types of markets, we have the foreign exchange market, also called the forex, okay, or FX, where currencies are traded, being the largest financial market in the world with daily turnover of $7.5 trillion, open for 24 hours and 5 days a week. Example of such instrument is the Euro USD and the GBP JPY. We also have the stock market, also called the equity market, where shares of companies are bought and sold, provides companies with capital and gives investors ownership, that's equity. An example is the New York Stock Exchange. We also have the London Stock Exchange. In Ghana here, we also have the Ghana Stock Exchange. Now we go to the bond market, also called the debt market, where governments and corporations issue debt securities to raise funds. Investors lend money in exchange for interest payments. Sample is the US Treasury bonds, and also we have the corporate bonds. We also have the commodity market, where raw materials and natural resources are traded, which includes hard commodities like gold, crude oil, and soft commodities like coffee and wheat. Example is the Chicago Mercantile Exchange. We have the London Metal Exchange. These are all commodity markets. We also have the derivatives market, which involves contracts whose value comes from an underlying asset, that are stocks, currencies, commodities, which also includes futures, options, swaps, and often used for hedging and speculation. We all have the money market, which deals with short-term borrowing, lending less than 1 year, which also includes treasury bills, commercial papers, certificates of deposit, and this type of market provides liquidity to governments and corporations. We also have the crypto market, which is also a newer market. Newer market in essence is a market which was recently introduced, right? Yeah, I think probably 15 years ago. It's the crypto markets are digital assets like the Bitcoin, Ethereum, and stable coins are traded. It operates 24/7, unlike the traditional market we have. It's very volatile and largely unregulated in many countries. Importance of the forex trading. One, forex trading being the largest financial market in the world, having a daily turnover of $7.5 trillion, a role in the global trade and investment, and is actually used by governments and central banks and corporations and individuals. What are the market participants? Who are those people that are involved in the markets? The highest, so this is actually arranged in a hierarchy where the highest to the lowest. So we have the central banks being the highest, followed by the commercial and investment banks. We have the corporations, okay. We also have hedge funds and institutional investors and retail traders. So the central banks are the banks in which control the economy of a country. For example, is in Ghana we have the Bank of Ghana. In US we have the Bank of America, and I think we have in UK they have the Bank of England also. Yeah, is it Bank of London, or I think I have to check it. So there's that. Um, The forex market structure, major trade. So the forex market structure is actually how the forex market is being structured. We have the major trading hubs, that's the London, the New York, and Tokyo, and also Singapore. It's being traded that's Monday to Friday and 24 hours in it. It has three main sessions. We have the Asian session, the European session, and the US session. So these are the three main sessions in the forex market. These the sessions are basically times in which the major trading hubs are actually active. Yeah. So we have currency pairs because these are the things in which you are going to trade on. So the currency pairs or currencies are a medium of exchange in which countries actually use for buying and selling of what goods and services. So we have some currencies which are major. So we call them the major currency pairs or the major pairs. We also have the minor pairs, or also called the cross currency pairs. We also have the exotic pairs, and those are the. So for the major pairs, most they are most traded and always include what the US dollar. Example is the Euro USD. So any pair that is paired with the US dollar is what a major currency or pair or a major pair. Um, some examples like I said is the Euro USD, GBP USD, the USD CHF, the AUD USD. These are major pairs. We have the minor pairs also called the cross currency pairs. That these are pairs that do not include the USD but involve other major currencies like the Euro GBP, the AUD GBP, the GBP JPY. These are cross currency pairs. We also have exotic currency pairs or exotic pairs. One major currency paired with a currency from an emerging or a smaller economy. Okay, the exotic pairs are pairs that are paired with what? A major currency paired with what? A smaller economy. So we have the USD TRI, that's the Turkish lira, the South African rand, the Nigerian naira. These are exotic pairs. So these are the types of pairs we have, right? So you understand why we do the pairing of currency pairs. So the reason why we have the pairings of currency pairs is basically to understand what we actually do. So to understand what we do with the pairing, I want to find this thing. Okay, so let me move on. I think I will do it along the line because I wanted to draw something, but it seems I'm not finding that particular thing in which I want to use to draw. Okay, so I think once I'm not finding it, I'm surprised I'm not able to find it. Okay, so let's move on. Still not finding it. Okay, so we see over here that the currency pairs are actually paired. That we have a first three letter of the particular currency, first currency and the second currency. So the first currency you see is called the base currency, and the remaining currency is called the quote currency. So meaning that whatever currency you see over there is being paired with another currency. Okay, so the base currency is the one here, and the quote currency is the one here. So it says they show the relative strength of one currency against another. Traders analyze pairs to predict price movement and profit from changes in the exchange rates. Okay, so how trading works. So how trading works is trading you trade in pairs. So in forex you trade one currency for another. So An example is the Euro USD. So if you expect the Euro to rise against the dollar, you buy the Euro USD. And if you expect the Euro to fall, you sell the hot Euro USD. So we also have price quotes. Each price has a bid price. That's the price that the market will pay you, and an ask price what you pay to buy. The difference is called the spread, which is the broker's fee. So we have certain brokers having a high spread because the bid price and the ask price is huge, right? Yeah, it's way wider, so the spread is big. We also have leverage and margin. Forex brokers allow traders to control large positions with small deposits. Example is the 1:100 leverage. That's a trader with $100 capital can control that's 10,000 in trades, right? So they've given you 100 times that particular amount in which you are using. So leverage increases both profit and risk. So in as much as leverage is very good, you should also know that it can also harm you. So leverage is just like a a double-edged sword. Okay, so forex market hours, or the market hours. Forex runs 24 hours a day, 5 days a week, and across 3 sessions. That's the European, the Asian, and the US. This makes it accessible anytime depending on your time zone. We also have the profit making, or the making of profit or loss. Profit comes from the change in exchange rates. For example, you buy Euro USD at 1 is to at 1.1000 and sell at 1.200, meaning there's a profit of 200 pips. If market moves against you, you take a loss of 200 pips. Analysis and strategy. Traders use fundamental analysis, which is the news, interest rates, and the economy, and technical analysis, that's chart indicators, patterns to predict price movement. Risk management tools like the stop loss and take profit orders help limit losses or lock in gains. So now we are going to talk about the tools and platforms that are actually used in trading. Now, with the tools and platforms used in trading, we have the softwares, we have certain softwares that traders use in trading. An example of such software is the MetaTrader 4, the MetaTrader 5, and also the MetaTrader web platforms. Also, we have the MetaTrader 5, the C Trader. Yeah. Okay, so charting platforms like the Trading View is also used for technical analysis. This is a place where we use we steady price movement. Yes, and it provide candlestick charts, trend lines, support and resistance, and indicators like the moving averages, the relative strength indicator, the MACD, and the Bollinger Bands. And a popular example is the Trading View. We also have the MetaTrader, where people also use that same platform as the charting tool. And it also has these indicators and charts. It provides a candlestick charts. Okay. We also have economic calendars. Economic calendars like for showing interest rate decisions and inflation reports, also employment data that affect currency pairs. Example is investing.com We also have Forex Factory, right? Forex Factory, which is a very popular one, and the interface is just like the one over here. Okay, so when we come to risk management tools, for risk management is a very particular tool in which is actually very very important when it comes to trading, because um, each and every time, the reason why risk management is very very important in trading is it helps the trader, it protects the trader for most of the time, and in as much as it's very very important for traders to actually manage their risk, it's also one thing that um, we take note of whenever we are trading. Yeah. I want to see if I can have this pen. Okay, so if I can't find it, let me continue like that. So we have risk management tools like a stop loss, right? A stop loss which automatically closes a losing trade at a set level. So let's say I've entered a trade, and in the trade I see that I'm losing. I You set what we call a stop loss, in which closes automatically once price gets to that level. It closes the market so that it protects the trader from losing more than he's supposed to. Losing more. Okay, losing more, or probably losing the whole account. Okay. So the same thing also happens for the take profit orders, right? That's take profit orders, which also locks traders when they are in profit. Okay, when their price target price is actually hit. So, in order not to actually for you not price not to reverse at you when we get to the set target in which you set price for, you set for price. Once price gets to that level, it takes you out automatically. Same thing. We also have position size calculators. Position size calculators are um, uh, a tool, or it's a tool in which helps manage your risk, in a sense that let's say you have a trade, and let's say in the trade you've made up your mind you want to lose, let's say $20. It calculates the amount of size or position lots you are supposed to actually enter in that particular trade. Okay. We also have types of analysis. So over here we have it's three types of analysis. I'll not talk about the other one. I'll just be basing on two. We have the fundamental analysis and the technical analysis, right? The fundamental analysis and the technical analysis. For the fundamental analysis, this it focuses on the country's economic health and global events. Traders study factors like interest rates and central bank policies, like the inflation, GDP growth, employment data, political events, and global news. These are examples of fundamental analysis, okay, which determine a country's economic health, okay, and some global events in which are happening in that particular country. Example is if the US raises interest rates, the US often strengthens. So if the US government actually raises or increases the interest rate, it's going to cause the dollar to actually become stronger. We have technical analysis, which also focuses on price charts and patterns to predict future movement. It uses historical data and indicators such as moving averages, RSI, MACD, support and resistance levels. Okay, so if Euro USD breaks above a resistance, traders expect price to rise further. So let's say we have an area that is supposed to be a resistance, and we have a support here. So let's say price has bounced from a support and is going towards a resistance. Okay, so once it gets to the resistance, then price a bounce price. Okay, it's resisting price. So once it resists price, and immediately we see price actually breaking through what, okay, that resistance, we can, traders can expect, okay, or they can anticipate that, definitely then maybe price can actually come into that area again and or start pushing high. So this is also another type of what technical analysis and what people actually use or traders use to what, make decisions in the market. Now you may ask that, okay, now after learning all these things, how do a trader learn the trading skill? So you have to first learn the skill, practice it, perform it. Okay, because trading is a performance skill, and after performing it, you profit from what, the skill. Um, I'm going to release an intermediate course concerning uh, this particular series I'm doing. So in the next course, we are going to talk about the pips and lots, ask price and bid price, types of orders, candlestick anatomy, buying and selling concepts, and also market structure. I'll release it very soon. I will release it very soon. So let's wait and see what happens. So thank you very much for staying behind and watching this particular video. And I believe with the subsequent ones, you would actually learn a lot from it. And I also want to remind you, if you've not subscribed yet, subscribe and also like the video. Okay, like the video so that we can actually grow as a community. So I have a Telegram channel. I think in the description, I'll put it in the description of this particular video. So if you want to join and also learn more on how we trade day in, day out, every week I drop trading analysis for Euro USD. That's the only, but I've added more pairs to it. I'm now trading. I'm also trading GBP USD and also gold. So I think for now these are the instruments I trade. Okay, these are the instruments I trade. So I make analysis on them, weekly analysis. Okay, weekly analysis on this particular instrument and what I'm expecting for that week. Okay, so let's see what happens. Maybe in the course of the week, I might drop the intermediate course. Okay, I'm down preparing it, but it's not on this particular slide. So I'll drop the intermediate course maybe during the week. And let's see how it actually goes. And I believe you would learn a lot. So thank you very much for staying behind. God bless you.